There's a certain ETF out there that's catching a ton of buzz lately on YouTube and on TikTok. That fund is QYLD. Some people call it the QYLDs. There are entire channels on YouTube right now dedicated to just talking about QYLD and how it's the best opportunity that young people have to ever retire early and live financially independent. And I can understand the temptation. This fund is yielding 11%, sometimes 12% depending on the month. So you can get a substantial amount of money from it by doing just nothing, just sitting on it and letting that dividend come to you. Now me, I don't have a regular job anymore, so it's important to me that I'm not invested totally in growth. I need some dividend. So I threw $85,000 at QYLD. It's about 13% of my portfolio. That bought me about 4,000 shares. And with that, I've been getting about $740 a month for just holding those shares and letting that dividend come to me. Now, $740 a month, that's not enough to live off of, but it's a respectable amount. That's a good safety net for people like me. I mean, that's twice as much as I was getting in college for selling my blood plasma twice a week. Now, there certainly are situations when people should use QYLD, but I think I made a mistake by investing into this fund. And I want to talk about this serious problem for QYLD, especially for young people like myself. Now, typically, if you see a regular old stock yielding 12%, that indicates that there's some kind of problem with the company. The market either doesn't believe that the company can continue making enough profit to keep paying 12%, or the stock has recently dropped precipitously, and that's why the yield is so high. Now, that's not the problem that QYLD has, because it's not a regular old company paying out its profits to shareholders in the form of dividend. Instead, QYLD makes its money by using the covered call strategy. Now, if you're watching this channel, I assume you know what a covered call is. You own 100 shares of stock, and you sell a call to somebody in exchange for premium. They pay you on the spot, and now you are on the hook until expiration day to sell the stock at the strike price if the buyer of that call decides to execute on it. If you own 100 shares of stock, this is a great way to get some extra money off of it. I use covered calls all the time. I think a lot of people in Theta Gang use covered calls, but it can be somewhat logistically challenging, especially for new people. But if you look at an ETF like QQQ, that's the NASDAQ 100 ETF, that costs $350. Most people, especially new investors, they don't have $35,000 to throw down for 100 shares of QQQ. So a company, Global X, realized there is a market for people that are either unable or unwilling to put down that kind of money to run covered calls themselves, but they still want that income advantage from it. So what did Global X do? They created an ETF that does this for you. So you can invest a very small amount of money, but still receive the benefits of selling covered calls. And so far, I think that's great. I think this is a great way to get people that advantage without them having to put up that kind of money themselves. But the way Global X implemented this strategy is a very serious problem. The mechanics just don't check out. Every month, Global X goes out and they buy equities of every stock that's traded on the NASDAQ. And then they go to the NASDAQ index and then they sell an at-the-money 30-day to expiration covered call. And they receive premium for doing so. On day 29, no matter what those stocks did, no matter what the index did, on day 29, they liquidate the entire fund and go back to cash just momentarily. They distribute their funds to shareholders that they received from premium on day 1, and then they go ahead and buy new equities and sell an at-the-money covered call again. They just repeat the same process every month. The problem here stems from that at-the-money strike price. Imagine you are using covered calls on QQQ yourself. You buy 100 shares at $350. The ETF drops down to $330. If I'm selling covered calls on QQQ, I'm not going to start selling at the money 330 calls. I'm going to sell the 350s again, or I'm going to sell the 340s again. That way I'm giving myself some space so that when the market recovers, I'm not stuck pinned down to sell at 330 and lock in that loss. When I'm selling covered calls, I need to stay focused on my basis, and I don't want to continuously sell at the money covered calls as the market drops. In that case, I'd be setting myself up to never have an opportunity to recover. Now, granted, if you keep selling at the money covered calls, the premium is going to be higher. You're going to get great income from it, but you have almost no chance of ever rising back up in price along with the rest of the market. We know that stocks only go up over the long term, so it's problematic to continuously sell this lower and lower strike price as the market drops. And then when it starts rising again, you are unable to participate because you sold a covered call at a lower strike price. So the way Global X runs its covered call ETF is not the way that we would run it. A ton of people, myself included, are all jumping into QYLD to chase this high dividend, but they're not realizing that the mechanics of how this fund operates is virtually guaranteeing that over the long term, the fund will continue depreciating. And I can prove this too. QYLD started trading in 2013 for $25, but in 2018 we had a 3-month bear market. QYLD has never recovered from that in 2018, even though the market itself is way higher than it was back then. It got close to recovering, but then 2020 came, and QYLD has never recovered from 2020. And we know how much higher the market is now versus where it was in 2020. And looking at where we are now in 2022, I'm not confident that QYLD is ever going to make it back to $22 where it was before this bear market started. Anyone who invested back in 2013, they're okay. It's not like they lost money as long as they kept reinvesting their dividends. But if they did do so, then they're throwing money right back into a depreciating asset. Basically, they're giving up their dividend in exchange for additional capital losses. Now, like I said, there are some people investing in QYLD who should be investing in this fund. But what I'm seeing on YouTube especially is that mostly young people are chasing into this. And for people like me, I'm 31, this isn't what we need. I'm going to throw another fund at you that I think is going to work a lot better. This is a mutual fund called QQQX. It's extremely similar to QYLD, but they do things a little bit better, and here's why. While QYLD sells covered calls on 100% of its position, gives itself no room for growth, QQQX actively decides, are they going to sell covered calls on anywhere from 35% up to 75% of their position, with a long-term goal of 55%. That way, they're only selling covered calls on generally a little bit more than half of their position. They're taking a smaller premium each time, but they're giving themselves a lot of room for growth. And this is especially what we need after the market has declined. We need to give ourselves room for our stock to recover. QYLD does not do that. QQQX does. But what are we giving up in dividend versus what we're gaining in growth? Let me show you. Here's what happens if you put $10,000 into each of these funds. You've got QQQ, where the dividend is negligible. You've got QYLD, generally yielding about 12%. And then QQQX is a little bit more variable, but over time, it averages out to about 7.1% dividend. If you look at 2020 highlighted there, you're getting $400 more with QYLD versus QQQX. It's over a year's time frame. So no argument there, you're definitely getting more money with QYLD. And in my case, with an $85,000 investment, if I were to use QQQX instead, I'd be getting about $1,500 per quarter. QQQX doesn't pay monthly, they pay quarterly. So I'd be getting about $1,500 a quarter versus over 3 months with QYLD, I'd be getting about $2,200. Now going from QYLD to QQQX, I'd be giving up $700 a quarter in income, so that's an appreciable amount of money. But in order to get that higher dividend, let's take a look now at what we're giving up. Now this graph is showing you those same 3 hypothetical portfolios. This time, if you reinvested your dividends, here's what happens to your portfolio over time. So Triple Q, of course, 4 X's, no surprise, growth is winning out. But we're not here for just growth. We need some dividend. That's why we're even considering QYLD. So if we invested this into QYLD and continued to reinvest in the dividends, then over the past 8 years, we'd be up about 80%. QQQX, on the other hand, with dividends reinvested, is up almost 3x. So what you're giving up by investing in QYLD instead of QQQX is all this growth. So by investing in QYLD and reinvesting your dividends, which is what I see most people on YouTube and on Reddit, the QYLD gang subreddit, they're all reinvesting their dividends. And by doing that, you're just missing out on all of this growth. And since you're reinvesting, it's not like you're actually taking the money and using it. So you're not really gaining income. So when you think about what these people are really trying to do, you're trying to take an income instrument and grow your portfolio with it. Well, we have another type of fund that can do that. They're called growth funds. And remember, this graph is with dividends reinvested. If we do without dividends reinvested, QYLD is actually down 16.7%, versus QQQX is up 40%. If you're young and you've got a long time horizon, 20, 30, even 40 years, investing into QYLD and trying to reinvest your dividends to grow a portfolio, this isn't what you need. Not only are you missing out on all the growth that the market offers, but you're investing in something that is continuously decreasing in value. You're throwing your reinvested dividends right back into a stock that's going to continue going down. Basically, you're giving up some of your dividend knowing that you're going to lose it to capital losses. The best way to manage your portfolio is to keep as much as you can for your risk tolerance invested into growth funds, and then the remainder of it should be going into income. Now, I'm only 31 years old. I should be pretty aggressively invested, but I don't have a job. I don't receive a W-2 and I don't receive a paycheck, and therefore I can't have all of my money invested in growth. I need that safety net. So I have elected to receive some dividend each month, even though I'm probably underperforming just a purely growth portfolio. But not everybody's personal risk tolerance allows them to be strictly invested in growth. And like me, you need some income. But don't try to use income instruments to grow a portfolio. It doesn't make sense. We already have growth instruments that can do that. Now keep in mind that after years and years of growth and income, a blend of it, you can switch entirely over to income later. You might have to pay tax on it if you're in a non-retirement account. But if you're in a retirement account, you don't have to pay any taxes at all. You can just continuously switch back and forth as often as you want to without paying a tax penalty. Now, like I've said, there are some people who should be investing in QYLD. I think the average person investing in QYLD is not this type of person, but this type of person does exist. So if you're ready to enjoy your retirement, you're looking at your finances and you're saying 7% dividend from QQQX, it's not quite enough for me to live the lifestyle that I want. I need that 12% dividend from QYLD. Well, if that's the case, then go ahead, put your money in QYLD, get your higher dividend, live the lifestyle that you want. Don't worry about growth at all. But if that's not you, if that doesn't describe your situation, then you don't need to be investing in QYLD. You need something more growth-oriented, at least enough so that it's not a depreciating asset. Now, I'd make the argument that if you're reinvesting your dividends at all, then that means you don't need the income, and therefore you should be focused on a more growth-oriented portfolio, at least something that's an appreciating asset. Don't keep throwing your reinvested dividends right back into a depreciating asset. And let's not forget, you've still got to pay taxes on your dividends. Even if you reinvest it, you've still got to pay tax on it. So that 12% that you're getting from QYLD, after tax, it's not 12% anymore. Now, if you really don't like QQX for some reason, you want to invest in something else, then consider JEPI or NUSI. Those are also very popular. I know there's a lot of people out there that are probably going to hate this video. They're going to try to fight it. And those people are just like me, because we were led to believe that QYLD is this fantastic investment that's going to give us a lot of passive income so that we can achieve financial independence early. But after being involved in this stock for about 8 months, I'm realizing this isn't what people are talking about on QYLD Gang subreddit. It's not what people are talking about on YouTube. Social media isn't accurately describing how this fund operates, and we're all getting sucked into it, not realizing what we're giving up in exchange for chasing this dividend. After 8 months, I finally made this switch from QYLD to QQX, and I think this fund is going to be a lot better for me, and I think it's going to be a lot better for most of the people that are investing in QYLD. If you insist on using QYLD for some reason, and you really want to reinvest these dividends, then at least reinvest them into something somewhat growth-oriented. Don't take your dividend and throw it right back into QYLD. Throw it into QQQ, throw it into SPY, or if you really want to go for it, throw it into TQQQ. That's a triple leveraged version of QQQ. Normally that might be a little bit beyond your risk tolerance, but if you have this very income-oriented portfolio with a large position in QYLD, then you should be balancing that out with growth, and TQQQ can help you achieve that. Anyway, this is just my reflections on it, so chew it over, think about it, sleep on it, see how you feel next time you look at your QYLD investment, and decide if it's really what you need. No matter what you decide, I want to thank you for watching, and I hope to see you in the next video.